Hello everybody, welcome to Online Trading Academy and OT Academy's webinar series. Today we're going to have a fantastic discussion. We're going to talk about a topic that is something that the industry has portrayed this extremely negative picture on. Every day we are faced with headlines that talk about how much you should put in. They actually don't even say how much you should put into retirement. Just put in. Keep funneling money in as much as you can, and hopefully at some point you'll have enough to retire on. But that kind of leaves this too open-ended. So today we're going to talk about simple steps to calculate what you'll need during retirement. We're really going to look at 3 simple factors. By the end of day today, there should be zero confusion on every one of yours part. So if you do have a financial advisor, you'll be more prepared to talk to them about what you need during retirement. If you don't have a financial advisor, great. You could do it all yourself, but at least you will know exactly where you need to be. So when you finally do reach that golden age, that retirement years, you'll be set and looking pretty. All right, so let's start things off with a little bit of a disclaimer out there, just so we get an understanding. This is an educational purpose. We're going to be really going over some high-level concepts, some that are out in the industry, some that are just kind of a perspective on a traditional way of investing. So there's your little disclaimer for you. Now, obviously, when we think of retirement, this is what most of us are holding in our heads. Beaches, sand, sunshine, cocktails, and just nothing, just chilling, relaxing, and enjoying life. And this is what our society, and not just the United States, but everybody around the world, has been painting this picture of retirement. Now, for some that aren't prepared, and according to some of the recent statistics, it's pretty ugly out there. I read one recently by one of the retirement agencies said that the average American has less than $20,000 saved for retirement, which means your retirement might look more like this. Now, I'm kidding, this is a bit extreme. I don't think that that's what it's going to resort to, but let's look at why this has been set up this way and some of the problems that we have with our current retirement system. So if we think about how long we're supposed to work in the ideal American retirement scheme, you're really starting to invest right around 25 years old. You're working for 40 years, paying into the system and doing all that, and then you retire. And then it was originally set up to your retirement was going to really carry you through till it ended, till you punch that ticket and we are no longer here. So that was about 10 years because retirement was at 65. Remember, average life expectancy was about 70, 73, maybe 75 years old. So if you retire at 65, that's 10 years. So you've saved up all this money for 40 years and it really should last you 10. That seems logical. But the interesting thing has happened with technology, science, and innovations is we are now experiencing a culture, a society where retirement money should last you much longer, maybe 25, maybe even more. So if you retired at 65, now you're looking at maybe money that should last you to 85, possibly 90 years, even longer. So it's critical that we adjust our viewpoint, our strategy, so that we don't get caught up in this old-fashioned way where that retirement money lasts us 10 years. That's one of the major steps. So as we build out this illustration, remember, we are spending a long time, 40 years for most of us, to build up our retirement accounts. And that's what I put a number 1 on here, because this is really what the industries are trying to get us to put into. They want us to put as much money. Remember, let's be brutally honest here, brutally honest. A retirement firm does not care about your retirement in any way, shape, or form. They don't care about you and your golden years. What they care about is that you put money into their account so that they have assets under management and they grow and they make money off of it. It's not altruism. They're not there to help you out and make sure that you have a great retirement, because if they did, they wouldn't be charging you fees. So this is what they focus on. That's why I put number 1. They want you to put in as much as possible so they make money. Now, what we haven't established, and I've never seen a commercial out there on TV or from an analyst that says, hey, how much do you need during retirement, and what is that exact number? So number 2 here, this big vertical line, basically says, what is the amount of money needed in my account when I retire that is going to sustain my living during my retirement years? That is a number that kind of eludes people out there. Third element is really the withdraw from that period of number 2. And we'll call that phase 3. This is really, I guess, the order of importance that the financial industries around the world, mind you, and I see we've got Gary and Imagine and JT, and I see you guys chatting out there, so hello everybody. And hello from Switzerland. This is the order that our financial institutions put this stuff in. We believe it's different. And watch these numbers flip here. We switched those because for us, number 3, the least important here is the getting there. We have 40 years to build those accounts up. We have time. Number two is that number that we have to have when we retire, and actually the most important one is the amount of capital that we need during retirement. So let's start there. Let's focus on that, determining what we need during retirement. And of course, you guys can see this is pretty much going to be a down-sloping line because we're going to be extracting money from this account on a periodic basis, probably monthly. But what does that look like? So step number one for all of you today, tonight, whenever you watch this, is to go and look at your personal expenses. Now this one's tricky because we have to take a step back and think long term. Where are we going to be in retirement? So these numbers could be different by then, but we need to start. So let's say, for example, we don't own our home. We put up here that you have rent of $1,000 a month. Yes, I know for those of you living in California and New York City, you probably just laughed out loud right now at $1,000 a month. That's like a box down by the river. But if you live in Ohio, that's probably a fairly nice place out there for $1,000 a month. So this obviously needs to be tailored to where you live. Food. Food prices vary greatly. There's eating out a lot. There's also cooking at home. I've got phone on here. We have transportation, so that could be buses because, get over 70, you probably lose your driver's license anyway. You have gas. You have electric, entertainment. I myself would probably bump my entertainment up a little bit more here. And then you have things like clothing. So we just did some rough numbers. In my calculations, my assumption is my home is paid off, so I don't even have that $1,000 rent, which is great because I'll just put that towards my entertainment. All right, so let's say we have $3,000 in total expenses. Again, be very picky here. Make sure that you do it to fit what your needs are. And I would say whatever number you pick, just to be safe, whatever number you pick. So let's say you said entertainment was $200. Add 10% to it, just to give you a little bit of a cushion, just a little buffer, all right? So in this example, we're looking at $3,000 worth of expenses per month. Okay, now we want to say, what money do we expect to have coming in? Now, some of you might have pensions, some of you might be collecting Social Security or some government support. So let's say that this individual has the average here in the United States, which is $1,500 per month in Social Security. So map that one out. So now we have the two variables that will tell us exactly how much we need per month. We have $3,000 worth of expenses. We have $1,500 worth of income, which means that we need $1,500 a month during retirement. That actually is not that challenging to attain. Of course, all of our numbers are going to be very different, so make sure that you guys tailor this one to you. Don't just use these numbers, please. All right, so we go from here to an annual number. At $1,500 a month, multiply that by 12, you're looking at $18,000 annually. So right away, as of 7 minutes into this video, you have learned more than any financial advisor has ever told you. You now have a good understanding of what you need in retirement. Not what you want, not what your advisor is telling you need to grow your account to $18 million. You know what you need per month. So now we can backtrack out the calculations. And this is where it actually gets rather easy and doesn't seem as daunting. Let's be honest, for a lot of people out there, especially after the 2009 and 8 and 9 financial crisis, a lot of people were anxious, felt really nervous because their retirement accounts evaporated. And there's a lot of people who might be facing retirement right now with markets at all-time high. So a lot of this has to do with market timing, and a lot of people don't have a lot of money saved up. It's okay. Knowing what you need gives you an end goal. So now we can build what we need to get to that $18,000 a month. So that brings us to our step number 2 here, which is that big vertical line. That big vertical line is simply, what should my account be the day I retire so that now I can effectively pull out $18,000 a year in this example? So let's calculate required savings needed at retirement. It's actually very, very simple. It's called, I'll be all dramatic, the 4% rule. It's called the 4% rule. This is a rule that's kind of been in place in the financial markets for a long time. And really what it says is during retirement, you should, in your first year, pull out 4%. Now, I am going to use a streamlined example here, which says just pull out 4% and leave it. You're not gaining any money on this account whatsoever. So let's look visually at what this looks like as far as gains and what numbers we should be putting in here. So the 4% rule basically says your annual needs, how much we need per year, divided by how much you have saved. So if 4% is our goal and we know our annual needs are $18,000, then the money saved formula is pretty simple. It's $450,000. So in this example, if an individual retired at 65 with $450,000, they could pull out $18,000 a year, and that would equal 4%. Now, what does this look like visually? Well, you guys remember the illustration that we drew earlier? It kind of looked like a pyramid almost. This is the back half of it. This is that middle post and the back half of that triangle. And you can see we started at $450,000 up there, and then if you pull out $18,000 per year, you can see it lasts until 90, which is right now more than any life expectancy around the world. I believe Japan leads the modernized countries at 83 or 84 years is the average life expectancy out there. I think it's 78 in the United States. But you can see this money would last us to 90 years. However, there's one problem. This would be in a perfect world where nothing is manipulated and inflation is not a part. Well, we have a historical average of 3% inflation. So what I wanted to do is show you that the impact of inflation here. So let's assume that we're taking out 4% per year, but we're also experiencing a silent killer, which is 3% inflation. Look at what happens to the rate of return here. It clearly shifts. So all of a sudden, that money that we thought was going to last us to 90 only lasts us to 84 years of age. What that does is that basically kills 6 years of our money is taken away because of inflation. So certainly we need to accommodate for this. In your calculations, you might want to factor in 3% inflation, and you might want to factor in maybe a little bit of work, meaning that this money, this $450,000, is not just sitting there doing nothing. It's not sitting in a savings account. You might be putting it in a CD and getting 2% interest. You might be putting it in some bonds and getting 4 or 5, or maybe in the markets getting 8. So here's what that looks like. If we just left $450,000 in a bank account with no interest, we would be losing that 3% inflation, which means our account would literally be dropping by 3% per year for nothing. If we got a 4% rate of return, I was talking about bonds a little bit, that might be an option. With a 4% rate of return, you take away that 3% inflation, you're looking at 1% gain. And of course, if we had 8% rate of return, we take out inflation, you're looking at 5. And notice how much further that money goes. We can see it goes all the way out to about 99 years if we get an 8% rate of return. And that is including inflation. So this is an external calculation that you might want to be making, thinking of how we could be allocating that capital during retirement. And of course, we want to be in very, very low risk investments, guys. This is money that should not be put in any sort of risky environment. So for those of you thinking, hey, I'll just throw my 401k into Bitcoin. No, don't do that. This needs to be very safe investments. You might be looking at bond ladders. You might be looking at annuities, something that's going to give you almost a guaranteed rate of return. So now that we've covered these first two things, so we've got determining what you need during retirement. That's step number 1. That's probably the most important. Number 2 was calculate your required savings needed. Now let's go to the one that the financial institutions have been telling us that we have to focus on, and that is building up retirement account levels. And we're putting it to the levels needed here. So what do we look at here? It really boils down to 3 simple categories. Category number 1 is contribution. How much are you putting in? Is it $100 a month? Is it $1,000 a month? Generally, the guideline that the industry tells you to do, which if you followed this, you would be absolutely set for retirement. That is 10%. So if you made $4,000 a month and you put in $400 a month, you'd be set. And of course, it really depends on a couple other factors here. The major part there is time. So yes, 10% would totally set you up if you're investing for 40 years. But if you only have 3 years left to retirement and you're just starting out, probably not going to make it. So time as soon as possible. I think everybody that's watching this right now knows that compounding interest is an incredibly powerful force. But the later you start, the less impact it has. And I'll show you some illustrations here in just a minute, which will convey that and drive it home a little clearer to you. Our third element that we have to pay attention to is rate of return. All three, I was going to say which one is more important and more impactful. They're all extremely important. The goal here is to optimize all of these. So contribution, put in as much as you can without constraining yourself and your lifestyle that you have today. Time, if you're not started already, first thing you should be doing tomorrow morning is starting some sort of savings and investment in retirement. Rate of return, The industry, at least here in the United States, this is really the benchmark. They say that since the 1950s, the S&P moves between 8 and 10% per year. I just put 8% because if you shoot for 8%, you really have a good chance of achieving your financial goals and much, much more. All right, so we've got those three major variables out there: time, contribution, and rate of return. That will be what dictates how quick, how fast that account grows. So let's take a look at a couple different illustrations here. And I jumped the gun by showing you the chart, but I'm going to give you three examples, and I'm hoping that you guys, especially those of you on the chat, send in some comments and questions here on this one, because this is an individual starting at 25 years old, right? So he started at 25, he's investing until he is 65, or she. That means that they will be putting in for 40 years. Now, how much do they need to invest? What I did in this example is I went through the example that we looked at earlier, which is they need $450,000 at retirement. In order for a 25-year-old individual who's investing for 40 years to achieve $450,000 at retirement, they only need to put in $145 a month. That's not much. If you look at the average 25-year-old, $145 is like a bar tab. It's not much. Now, that's assuming an 8% rate of return. And visually, I hope that you guys all see the significance of this. Where does the growth of this account go parabolic? It really happens about year 23, 24, somewhere in here. It really starts to accelerate and move to the upside. You see, it just gets really, really steep. That means you're gaining so much money in interest every year because of compounding. Now, you'll notice that there's a line at the bottom of this chart also that just is kind of a straight diagonal. That simply illustrates how much money this individual has put in over time. And for 40 years, if you put in $145 a month, all told, this individual will have put in less than $75,000, but the account will be $450,000. That is a great, great example of compounding. So let's say, you know what, I'm assuming that most of us watching this right now are not in our 25, not 25. We might be a little bit older, maybe, I don't know, 45. So watch how different this is at 45. And again, I'm making the assumption this individual needs to get $450,000 by retirement. So here is an example of a 45-year-old individual who's going to invest until 65. So the investment period, that time variable that we talked about on our previous image, is cut in half. It's gone from 40 to 20. And if you invest $145 a month, as did the previous example, this individual would need to get a rate of return of 22.7% a year. That is not reasonable. That's probably not going to happen. So what we need to do is this individual has to modify their plan to figure out how to get to $450,000. Now, what I would suggest that this individual do is keep the benchmark rate of return at 8%. Now, if that happens, this individual, here we go, you have a rate of return of 8%. Notice how much more they would have to put in. It was $145 per month. In order to catch up for starting late, getting the same rate of return, this individual would need to put in $820 a month. That is that's a pretty big hit every month. And now, of course, they might be able to do that. But the point I'm trying to make is this is really an extra $680 a month that this person would have to put in because they were late, because they started late. So the key here is to start early. If I'm not mistaken, I believe Tony Tony, are you telling me you're 17? I got a gentleman in chat saying he's 17 out there. If you're 17 and you're starting this, it's even better. If you put in $145 a month into a retirement account and let that grow at 8%, I can't do the calculations here live because I don't have that spreadsheet, but I assure you it is going to be way, way more than $450,000. My assumption would be that you're probably going to get close to $600,000 or $700,000, and that's just because you're starting 8 years earlier than the ideal time. So, especially for those of you who are really young, if you are out there and you are in your teens, think about this stuff now, because I assure you your classmates are not thinking about this. They're thinking about other things, and if you start early, you will be so much further ahead of the game than anybody else in your peer group. So hopefully you are, Tony. All right. So this is the other part about this illustration, your example number 3, is look at how much money they have put in. So yes, the account is $450,000 when they retire, but in order to achieve that, they have put in $200,000. Seems simple. I mean, if you want to make your accounts grow, start early. So real basic stuff out there. There's really 3 things we need to look at. Step number 1 was determine what you need. Now, all of us are going to have different amounts. We all have different capital requirements, so make sure that you guys look and you check and see how much money you need during retirement. It's going to vary greatly. My number is significantly higher than that example out there that we've shown, but I wanted to use an example that was achievable and attainable to all individuals. I live in California, so it's actually very expensive to live out here. Now, the second element that we want to look at here is calculate required savings needed. That is pretty simple. Once we know what we need during retirement, whether that's $20,000 a month, $50,000 a month, or $5,000 a month, or $1,000 a month, you can now backtrack and find out exactly what you need. So that's actually the easiest calculation to make. Third step here is build up those retirement accounts. And this is actually what gives us the most flexibility. Again, it's contribution, it's time, it's rate of return. Those things we can work a lot with. And what we pride ourselves on at Online Trading Academy is understanding how we can increase our rate of return. It's not as simple as saying, let's just put our money in a CD. Well, that's easy, but you're going to get 1 or 2% interest. Who really cares? Oh, I could buy some treasuries. Maybe I get 2 or 3%, maybe 4. Well, that's great. But what if I use option strategies and I'm selling options, collecting premium, and now I'm getting maybe 1% a month? Now, all of a sudden, our rates of return become much more significant. Now, of course, options are risky investments, so we have to know what we're doing, which is why Online Trading Academy exists, to teach people how to use stocks, options, futures, commodities to help increase that rate of return. What I want to emphasize, though, is we are increasing our rate of return. Remember, the greater rate of return you're getting, the more risk you are generally taking. So we have to be very, very careful out there with that. Again, this is our nest egg, our retirement capital, so we should keep our risk to a minimum. Now, when we did a survey at the very beginning of this, I thought it was rather interesting how geographically, or how we were so dispersed with regards to our numbers. For example, 22% of those polled said that they know exactly how much they need during retirement. I actually, to be honest, I was shocked when I found that out. I still don't believe that, but I forget that a lot of our viewers are Online Trading Academy graduates, so now it makes more sense. The average person, if I was to go to a dinner party, which is people who were not involved in financial markets, and said, how much do you need exactly for retirement? I'll bet you 1 out of 50 would probably know that. 33% you said you have a rough estimate. Great. That means you're at least thinking about it and getting started. 11% I think I might know. That basically means that you don't know. We'll just extrapolate that and put that into what it really means, which is I don't really know what I need. And then 34% said you've never calculated it. Great. I'm actually happy to hear that, because I'm hoping that 34% of you will go home tonight or right after this video, and you will now be part of that 22 that says, I know exactly how much money I need during retirement. Now, this is a simple 3-step calculation formula to look at how all this works. Obviously, there's much more detail to it. There's a lot of moving parts. For example, how much money we need during retirement, or how much we grow our account by, rates of return, contribution, and time. Those variables we have to look at deeper, and those can be brought up in different asset classes and different subject matters. If you would like to know more about how the financial markets can help you increase your rate of return, learn about money management, learn about budgeting and that sort of thing, you can find out more information at www.otacademy.com. And of course, there's classes at tradingacademy.com to help you secure your financial future. I want to thank all of you out there for joining us today. I see we've got a pretty multinational crowd, so hello to everybody from all around the world. I hope you guys learned something today. Take care, everybody. We'll see you guys in future lessons.